All right, hello everyone. This is Jeremy Lovett, and this is Happy Home Buyer, episode number 2. Today we're going to be talking about the FHA loan and when to use it. It comes up all the time. Folks really don't understand when a conventional is best for them or when an FHA loan is best for them. But if you're somebody that's looking at buying like a $500,000+ home and putting 20% or more down, this isn't the segment for you. This is for pretty much anybody buying under that price point that's looking to put as little money down as possible and is just trying to see when is the FHA route the better one than the conventional route. So that's what I'm going to show you here today by going over a couple quick examples. And those examples start by checking on the rates. So the interest rates are going to be one of the more important pieces that we go over here because the interest rates are going to impact everything about the loan. So to do that, we go over to my little rate lookup tool here. You can find that on jjlevitt.com/my-rates. Anytime, type in your scenario. It tells you what the rates are. You can look up conventional, FHA, jumbo. You can look up everything. So what I did is I jumped on here and I put together 2 scenarios. We're going to make the same assumptions across all those scenarios. Assumption number 1 is you're buying a $250,000 home and you have exactly 5% in total out of pocket. So that 5% is to cover your down payment, closing costs, prepaids, the whole bit. Assumption number 2 is that you can qualify for both an FHA and a conventional loan. So we're not talking about VA or anything else. FHA versus conventional, you can qualify for both of those loans. We're also going to make the assumption, which is true right now, and that is that you're in a seller's market and it's going to be difficult to negotiate any seller-paid closing costs. So we're going to work out paying all your closing costs in a lender credit to make sure that you only come out of pocket with that 5%. So those are the assumptions we're making on top of what I'll show you here in the scenarios as they differ. So first, we're going to start with the high FICO scenario, which is not actually up. Here's the low FICO scenario. We can see that next. The high FICO scenario. So in this scenario, we are looking at the same assumptions we just went over, plus we're assuming you have a FICO score of 760. So here's our $250,000 loan amount. In this scenario, we're putting 5% down. I'm going to assume here that the closing costs and prepaids are going to add up to 2.5% of the sales price. This is an assumption. It's fairly accurate in our market. Everybody's scenario is different, but I had to pick a number. That's the number I chose, 2.5%. So putting 5% down here, it means I had to price the loan such that we had a 2.5% lender credit to cover all of those closing costs and prepaids. Give or take a few dollars, that's what we did. So in the end, on the conventional side, we've got a total cash to close of $12,500, roughly 5%. On the FHA side, I did the exact same thing. We've got a $250,000 loan. Our loan amount calculation is a little bit different though. On the FHA loan, you're only putting 3.5% down, but you're also financing their 1.75% upfront mortgage insurance premium. All that math, when it's done, means you have a loan amount of $245,000. You've got those same closing costs and prepaids, a smaller lender credit because remember, you only put 3.5% down. Still the same out of pocket, $12,500 give or take. Here's how that compares though on the high FICO comparison. The interest rate on the conventional side is 4.25% for us here this morning with a 4.579% APR. That gives us the lender credit that we talked about. If you weren't looking for a lender credit, our interest rate would be down in the 3s, but for this scenario, we're trying to keep it to exactly the 5% out of pocket. So your principal and interest payment's $1,168. Your mortgage insurance, that's what we're going to watch here. Not only is the interest rate sensitive to your credit score with the conventional loan, but so is the mortgage insurance. With this high FICO, the mortgage insurance is fairly low at $81 per month. Taxes and insurance together, we estimate at $225, so you're looking at a total payment of $1,474 per month if you went the conventional 5% down route and used a lender credit to pay all of your closing costs. On the FHA loan, it's a little bit different. The interest rates are lower on the FHA loans. It's a government-sponsored enterprise, the whole bit. There's reasons why the FHA interest rates are lower. We can go into that at another time. Feel free to reach out to me for info on that. But on the FHA, we're looking at 3.375% with a 4.182 APR. So that puts your principal and interest payment a little bit lower. FHA has a fixed monthly mortgage insurance. It doesn't fluctuate based on your credit score. It also stays on for the life of the loan, something we'll consider here in just a minute. But that FHA mortgage insurance is $169, estimated taxes $225, total monthly payment of $1479 per month. Those payments are very similar, but here's why in this particular scenario, you're not going with FHA. You're going to go with the conventional loan. First, $5 per month less, not a huge deal, but when you take into consideration the second piece, it's an $8,000 lower loan amount. With conventional, you're putting the full 5% down. So you've got a loan amount of $237,500. With FHA, you're only putting 3.5% down, and you're also going to finance 1.75% in their upfront mortgage insurance premium. When you look at the difference there, there's an $8,000 spread. So on day one, you owe $8,000 more on the FHA purchase, even though you put the same amount out of pocket. So that's reason number 2 why you're going FHA here. Reason number 3 is, like I said, the FHA mortgage insurance, that piece stays on for the life of the loan. With a conventional loan, once you've paid the principal balance down to 78% of the original purchase price, that mortgage insurance can be removed. So I know that that's a down the road perk, but the first one, the second one, those are reason enough. Having the MI removable down the road, just the nail in the coffin for why in this scenario you're not going with the FHA loan, you're going with conventional loan. But let's flip it up a little bit. Let's show you why, or in a scenario where you would go with the FHA loan. We're only changing one thing here, and that's the FICO score. Remember, we assume you qualify for both of these loans. We're doing all the same sales prices, all those fun things. The only thing I changed here is the FICO score. So all the numbers at the top are exactly the same because we're getting you to that $12,500 out of pocket. What changes is the conventional loan is extremely sensitive to your FICO score. So that interest rate went up from 4.25 to 4.875. You'll also see the mortgage insurance went up from like $80 a month to $294 a month. Those are huge jumps. The conventional loan just doesn't like the lower FICOs nearly as much. So that jumps your payment all the way up to $776 a month. On the flip side, the FHA loan is sensitive to your credit score, but not nearly as much. The interest rate only went up a little bit to 3.625 with a 4.426 APR. And you'll notice the mortgage insurance doesn't change. Like I said, the mortgage insurance doesn't fluctuate on FHA depending on how high or low your credit score is. So that mortgage insurance did not change. So when you look at this scenario as a whole, this is a scenario where you're probably going to go with the FHA loan because in the end, you've got a $262 a month less for your mortgage payment. Same $12,500 out of pocket for both of them, but your monthly mortgage payment will be $262 per month less with the FHA loan. Also, when you look at this, there's a lower interest rate even when the MI is factored in, and here's what I mean by that. If I take the 3.625% interest rate and I add FHA's monthly mortgage insurance premium, which works out to 0.85%, adding those two together still makes it lower than the conventional loan or the conventional interest rate of 4.875. Where this gets a tiny bit tricky is the fact that you still do have a loan amount that is $8,000 higher on day one. The way you work on that is you look at the number of months to break even. In this case, it's 31 months. And what I mean by that is you will, if the $262 per month you save, if you were to keep that loan for 31 months, you would have saved more than $8,000. So that offsets the initial fact that you have an $8,000 per month higher loan amount. Not everybody's going to factor that in, but that is something to consider. A lot of folks, when they're looking at this scenario, are just looking at getting their monthly payment as low as possible. This shows you how the FHA loan drops at $262 lower than the comparable conventional loan. So that's FHA loans. That's when you use them. Like I said, this comes up a lot when folks have that higher FICO score. A lot of times I'm able to show them with scenarios like this why the conventional loan is much better for them. When they've got FICO scores that are moderate to low, a lot of times we really need to look at the numbers and we need to have that conversation of how long you're going to stay in this property. Then we can just simply paint a picture of, okay, if you stay in it for 2 years, the FHA loan's better. If you stay in it for 15 years, maybe the conventional loan's better. So it's just having that conversation with your mortgage professional and just deciding which one's going to work best for your particular scenario. Because I understand everybody's scenario is different. Keep in mind, everything I said here was just putting these scenarios together, the 2.5% closing costs and prepaids, the whole bit. It's just painting the picture. I'm not guaranteeing you anything. I'm just trying to paint the picture and show you exactly what we're looking at. So if you have absolutely any questions on this, just give me a call. My direct line is 480-744-6040. And always check out my segment, This Happy Home Buyer. We're going to be doing this every single Tuesday. Going to give you the insider knowledge that you need to make sure that you stay happy when you're buying your home. Talk to you soon.